Is it better to put your money into investment or pay down your debt? Almost of us have to deal with this dilemma at some point in our lives. Why pay off your debt when you can invest to make more money? How much of your spare money should be spent on debt repayment or should be invested in a way that will grow and offer you phenomenal returns in later years? Even if either option makes logic, you'll be astonished of how much impact it makes. Making the right decision now might mean the difference between 10 of thousand and 10 of millions in the future. Here are the pros and cons of each option, so you can make an informed decision about whether or not you'll end up bankrupt or financially secure in the long run. Rise and Grind's YouTube channel is here to help you learn about personal finance, investing, and more. Subscribe to the channel, give this video a thumbs up if you found it helpful and you want to see more videos like this. A solid financial foundation is essential before making any long-term financial decision, such as whether or not pay down debt or invest. This essentially entails putting away an adequate sum of money in an emergency fund just for an anticipated cost. It's worthless to work down debt or invest if you don't have any emergency fund set away, because you never know when you might find yourself back when you started. If you need a major repair to your car but don't have any cash on hand, your only option are to take money out of your savings or to go into debt to pay for it. For any making significant life changes, it is important to have at least 3 to 6 months worth of living expenses saved up. When you've paid off all of your debt, you'll have a lot more money to spend. It can be challenging to make payments to oneself when multiple payments for debts are being taken out of your account at the same time. Payday to paycheck survival is more likely if you have more than one monthly bill to deal with. When this occurs, it gives you the impression that you are going to work each day solely for the purpose of paying the bills and are not making any progress financially. In spite of the fact that you're making regular payments on the principal of your loan, the majority of those amounts go to cover the interest. You'll feel like you've got a big increase after your old debts are paid off because you'll be keeping a larger portion of your income. Being debt-free makes it far easier to boost your retirement contributions, which could allow you to retire at earlier age. Alternatives include putting the excess money into investment before paying all of your debt. As a result, they are able to generate substantial gains from their investments, which had higher interest rates than their debts. What's the point of paying 5% interest on debt when you could be earning 10% or more? In order to get out of debt and start investing, you may have to wait for years, which means you'll miss out on a huge amount of compound interest that might have skyrocketed your fortune. With regard to debt reduction or investment, the risk is the most important consideration. A guaranteed return can be achieved by paying off your debts. If your credit card business is charging you interest at rate of 30% and you pay off the balance in full, you'll have effectively earned return on your money of 30% with no exposure to risk. A certain element of risk is inevitable in all elements. Is it likely to obtain a 10% or more profit by investing in the S&P 500 stock market index? Indeed, it is. Investopedia reports that from its inception, the S&P 500 index has returned an annualized rate or more than 10% on average. Despite this, there have been periods in history when investing in the market resulted in a loss. The return on investment for the S&P 500 index was minus 10% in the year 2000, a negative 13% in the year 2001, and a negative 20% in the year 2002. After then, there were several years in which returned profit, but in 2008, it reported a loss of 38%. When putting your financial strategy into action, is it essential to keep in mind that even the chances are on your side that you will make a profit over the course of many years, there is no assurance that you will do so, and this fact must be kept in mind at all times. Look at this easy world comparison between debt repayment and stock market investment. Let's imagine you owe $350,000 over the course of 30 years. If you borrow $6,000 per month at a 4% interest rate, your monthly payment will be $1,671. Your salary is adequate and you have an extra $1,000 in your pocket that you may either use to pay off your mortgage or invest in the stock market. In the end, you aren't sure which of the two options will leave you in the best financial position at the end of 30 years. Scenario 1. Paying off mortgage. If you make an additional payment of $1,000 on the principal of your mortgage each and every month, you'll pay off your debts 14 years and 5 months earlier than if you let the mortgage remain outstanding for the entire 30 years. As a result, your total interest payment will be just $110,799 over the course of the loan. That means you'll be investing an additional $1,000 per month, as well as the mortgage payment you already made, totaling $2,671. Over the course of 15 years and 7 months, a total of $1,203,916 will be amassed by making a monthly investment of $2,671. After deducting the total amount of interest you spent on your investment, which was $110,799, you will be left with a sum of $1,093,117 after 30 years. To put it another way, this is the sum of your accumulated funds less the interest you've paid. Second option is to pay only bare minimum and then put the money aside for an investment. When it comes to paying your mortgage, let's assume that your extra $1,000 per month is invested. It will cost you more than twice as much interest in over 30 years to merely pay the minimum payment, which is $251,544. For the same amount of money, you could invest $1,000 every month in the S&P 500, which would rise to $2,171,000 in 30 years. There is $2,171,000 invested, but only $1,099,456 left over after subtracting the interest. The difference between scenarios is $826,339. Nearly the course of 30 years, if you put extra $1,000 per month in the S&P 500 instead of paying down your debt, you'll finish up over $800,000 more in your bank account. That's a significant sum of money that might make or break your ability to retire. This doesn't address stock market risk and implies a good long-term return. Inflation is one of the most important advantages of a 30-year mortgage payment schedule for you to take advantage of. While the monthly payment on a mortgage stays unchanged in terms of dollars, the value of the dollar diminishes with time. This indicates that you will be able to repay your debt with dollars that have a lower value than they did before you took out of the loan. The dollar's worth is half every 18 years at 4% inflation. A simple calculation shows that in 18 years, your monthly mortgage payment will be halved. While you're paying off debt with dollars that aren't worth as much as they once were, you can put money into investment that will stay up with or even outperform inflation. There are two reasons why mortgage is more severe option when it comes to determining whether or not to pay debt or invest. Mortgages have historically had extremely cheap interest rates, maybe of the lowest on the market. Mortgage interest rates in 2021 are expected to be about 3%, which is close to existing inflation rate of 5%, meaning you're effectively taking out loans for nothing. Mortgages, on the other hand, can really be beneficial to some investor. Secondly, mortgages are typically long-term loans lasting at least 30 years. When you have loan with such a long duration, the decision of whether to pay it off or invest the extra funds is more important and should be examined carefully. It's not as simple as one might believe to decide whether to pay down debt. It should come that no surprise that cash flow is a significant advantage that can relieve your budget. This is something that is particularly necessary for investors who are more senior in age. Rather than focusing on whatever approach will provide you with the most money over the course of 30 years when preparing to retire, focus on the current cash flow instead. The importance of risk must be taken into account while deciding on a plan. The most profitable strategy is to pay off high-interest loans and take out low-interest ones. Alternatively, you might use extra money to pay off debt and invest at the same time. Obviously, there are many contrasting perspectives on this subject. The figures provide an accurate depiction of each scenario, and it's up to you to evaluate the potential for both loss and gain. Decide which option is best for you by considering all of the advantages and disadvantages of each one. We genuinely hope you had a good time watching this video. To see more videos about cryptocurrencies and finance, be sure to subscribe to our YouTube channel and show your support by giving us a thumbs up and commenting below. We appreciate you watching and we'll see you soon.